You know, you stress that any conditioning or any tightening will be conditioned on the health of the economy. What's the biggest risk you see out there that would make you say, it's you know, September, but there's something that has come up, some negative now in the economy that we're going to push this rate hike out in the future?
Yeah, I think there's probably two ones there. The first one, you know, to be glib to your viewers again, of course, is the COVID situation. At any point, we've just seen recently very close to us, Victoria, Melbourne, back under lockdown. You know, these events are dramatic. What it does is it really holds back the ability and the willingness to travel and to be a tourist, which is a big part of, you know, our revenue here in Aotearoa, New Zealand. So that's kind of the international one around which we watch. Domestically, we know that a big part of the spending increase we've seen has been driven through asset price wealth, particularly house prices, and also government spending. So we know balance sheets are far more stretched. There's a lot more debt out there. And so, you know, it's how households react if interest rates, you know, the threat of higher interest rates. We love to always forecast nice, smooth lines, but life doesn't work that way. So, you know, we're talking to people about saying, hey, you know, think hard about the medium term, not just the current price you're looking at.
You know, you are saying that you expect house prices to start flattening. Now, of course, that's a plus to the extent that these soaring home prices have been problematic for a lot of people in New Zealand. At the same time, if home prices flatten, does that perhaps flatten consumer spending as well?
Yes. You know, wealth is one of the channels monetary policy works through. When interest rates go down, assets become higher valued. People holding those assets feel wealthier, they go out spending. And we have seen that behaviour going on. But it's only one channel. You know, the other channels are through the exchange rate or through cash flow. Cash flow is probably the biggest, most important. We've already got baked into our projections a dramatic slowing in house price growth. In fact, it goes from double digit to zero over the next couple of quarters. What are the risks? Well, I'd say they're evenly balanced to taking longer to slow or slowing more dramatically. We know that the actual asset price moves far quicker than the underlying fundamentals. And what we've talked about here in New Zealand is that house prices had been growing far faster than any of the underlying fundamentals. Property, the taxation, population growth, very flat, taxation increases on housing investment, a significant increase in the supply of houses. All of these things suggest a much lower profile for house price growth in the absence of the psychology of people.
Now, I'd like to ask you a little bit more about inflation because, again, your time at the RBNZ covers years ago when inflation targeting was just being considered. So you've been watching these issues for a long time. And now the big question is it still the economy it was globally where prices just, there's no way to get them to move higher and stay there? Or have we had a game changer because of supply bottlenecks, but maybe also because of fiscal stimulus? There's so much spending out there. You two are saying you think the inflation surge was going to be temporary, like just about every other central banker in the world. What's your number one worry when you think, ooh, maybe I'm wrong?
I think underlying the important thing is the frameworks are the same. The assumptions you need to make are the same. The reaction, the goals and purposes of the central banks are the same. But conditions will always change. So you've talked there about government spending doing a bigger part of the lifting than monetary policy was left to do on its own. That is a very good thing. We have called central banks that said monetary policy need friends very often. Well, we've got friends. They are doing a big part of the aggregate lifting, which makes sense given the nature of the shock. So that is good. The second part is, you know, with the fear of the 70s, the 80s, the stagflation, it is such a different world. There is a single global price for so many of the raw materials, the intermediate inputs, and the final consumer goods for the globe. We Google that. We are prepared to wait. We don't go to the shop. We have it imported, so on and so forth. So, and likewise, there is increased global surplus supply capacity still. So the environment is still one of low and stable inflation. This is why central banks are probably showing more caution to the upside. They are prepared to wait longer because they are more confident that we have stable inflation expectations We have a much more flexible set of pricing. We have less of that generalised inflation. And that's where we sit. Inflation expectations are well anchored. They know we will react
Okay.
if they become unanchored, and we have signalled that.